In April 2026, the London Bullion Market Association published its monthly vault data, and the number that jumped off the spreadsheet was this. Combined Western free float silver, the metal not locked inside ETF structures and actually available to underpin trading, fell by approximately 285 metric tons, or roughly 9.2 million ounces in a single month. That is not a rounding error. It is not a seasonal adjustment. It is a directional signal from the world's single most important physical silver market, and it is pointing in one direction only. The total LBMA vault figure for April came in at approximately 27,454 tons, but as I have spent considerable time explaining on this channel, that headline number is a misleading comfort. The gross figure includes the enormous ETF-backed holdings, metal that is legally spoken for and functionally unavailable to clear trades. Strip that out, and the picture shifts dramatically. I want you to sit with that for a moment because this is where most retail observers stop reading. They see 27,000 plus tons and they relax. They should not be relaxing. The liquid free float is the silver that can actually be used to settle the billions of dollars in daily over-the-counter silver trades in London, is a fraction of that number, and the trend over the past year has been persistently lower. As I have analyzed on this channel before, the disconnect between what you see on a trading app and what you can actually hold in your hand has never been wider than it is today. The rehook here is important because the counter-argument will come fast. LBMA total holdings are not at record lows. In fact, the gross tonnage has recovered substantially from the troughs of mid-2025, when the vaults held as little as 24,199 tons, down nearly 50% from the COVID-era peak of 35,667 tons in April 2020. But recovery in gross holdings is not the same as recovery in market liquidity, and that distinction is the entire story of this video. What flowed back into London vaults after the mid-2025 lows was primarily ETF-backed metal. It was not freely floatable inventory, it was committed metal wearing a name tag. The free float, the number that actually matters for daily market function, has remained persistently constrained, sitting at roughly 140 million ounces or so through much of late 2025 and into early 2026, even as gross figures climbed. That is the paradox at the center of this market, and it explains why silver lease rates, a real-time proxy for physical availability in London, have behaved in ways the paper price simply does not reflect. To understand why this matters, you have to understand what the LBMA actually does. London is not where silver is primarily priced for headlines. New York and COMEX handle that role in the press. But London is where the metal physically lives. The daily average clearing volume in the London silver market exceeds 200 million ounces. That is not a typo. Over 200 million ounces of silver changes legal hands, on paper, in London every single day. The infrastructure underpinning those trades is the Vault network. Brinks, Malka Amit, Loomis, HSBC, ICBC Standard Bank, JP Morgan, these are the institutions that hold the bars. The reason I focus so heavily on the London vaults is that while New York sets the price, London holds the metal. And right now, the metal is leaving the building. The flow dynamics of 2025 and early 2026 are worth reconstructing precisely because they explain where we are now. In the first quarter of 2025, an extraordinary event unfolded. Traders became concerned that the incoming US administration would extend tariff coverage to silver. In response, a massive amount of metal was shipped from London to New York, some of it air freighted across the Atlantic, a logistical operation that would have been considered absurd in any prior year. COMEX inventories surged. LBMA inventories dropped by approximately 3,570 tons, or 115 million ounces, in that single quarter. This was not organic demand. It was preemptive arbitrage, a physical repositioning of metal driven by regulatory uncertainty. It caused real, measurable stress in the London market. Silver lease rates spiked. The exchange for physical spread, the premium paid to convert a COMEX futures contract into an immediate London spot delivery, widened from its historical norm of around 25 cents per ounce to over $1.10 at peak stress. That is a fourfold expansion of a spread that exists purely to cover the cost of moving metal between markets. Then the pressure reversed. Metal flowed back from COMEX and from the Shanghai Gold Exchange into London through the second half of 2025, which is why gross LBMA holdings recovered. But the key insight from independent analysts tracking this data, and I spent a significant portion of my preparation time cross-referencing 10 years of LBMA spreadsheets to verify this, is that the recovery in gross holdings did not restore the free float to pre-stress levels. The bars that came back were largely absorbed into ETF structures. SLV, the iShares Silver Trust managed by BlackRock with over $46 billion in assets, is backed by physical bars held in London vaults. Every ounce of SLV is, in theory, a London good delivery bar that is no longer available to settle an OTC trade. The same logic applies to ABRDN's SEVR and the European listed products. When ETFs grow, London gross holdings grow, but free float can simultaneously shrink. This is the structural tension that the monthly headline number obscures. The goal of this analysis is to give you the same data edge that institutional desks use, moving past the retail noise to see the structural cracks in the system. So let me walk you through the 5 signals I am watching right now, because no single data point tells the full story. The first signal is the free float trajectory. As of the April 2026 data, the combined Western free float, LBMA plus COMEX, excluding ETF-locked metal, sits at an estimated upper bound of approximately 14,251 metric tons, according to careful analysis of public data. That is a decrease of around 285 tons from the prior month, even accounting for the fact that London-based ETFs themselves shed approximately 63 tons of metal during April, which technically increased LBMA free float. The net result was still a drain. Silver was flowing out of the West. When you map the trajectory of this number over a multi-year window, what you see is a market that has been running a structural supply deficit for 6 consecutive years, according to the World Silver Survey, with each year drawing down the above-ground inventory buffer that previous decades accumulated. The cumulative deficit since 2021 now exceeds 760 million ounces. That is metal that was available before and is not available now. The second signal is the lease rate. This is the market's internal thermometer for physical availability in London. In a well-supplied market, the 1-month silver lease rate sits close to zero. It costs almost nothing to borrow metal because metal is plentiful. Through mid-2025, that rate was already elevated. By January 2026, at the peak of the delivery rush that accompanied silver's all-time high of 121.67 per ounce on January 29th, lease rates in the 1-month tenor had spiked to approximately 8% annually. For context, during the Hunt Brothers episode in 1980 and the 2011 surge to $49, lease rates were a fraction of that level. An 8% 1-month lease rate is the market screaming that it cannot find bars to lend. As of the current period in May 2026, with silver trading around $80 per ounce following a significant correction from the January peak, lease rates have moderated but have not returned to the historical baseline. 1-year lease rates remain above 5%, according to Bloomberg data cited by independent analysts, which signals that the structural tightness has not resolved. The correction in paper price did not bring new metal into the market. The bars that left did not come back simply because the number on the screen went down. The third signal is the ETF divergence, and this one carries particular weight. During the January 2026 price crash, as silver fell from $121 to the low 60s in a matter of days following extreme leveraged selling on January 30th, SLV experienced a dramatic structural stress event. The ETF's market price dropped to a 19.3% discount to its net asset value. That means investors in SLV were selling their shares at nearly 20% below the value of the physical silver the fund supposedly held. Under normal conditions, authorized participants arbitraged this spread instantly by redeeming ETF shares for physical bars and selling the metal. The fact that this discount persisted reflects one of two things. Either authorized participants were unwilling to absorb the physical metal at that price, or the operational mechanics of moving bars out of the vaults were constrained. Either interpretation is significant. Meanwhile, the Sprott Physical Silver Trust, PSLV, which holds fully allocated, unencumbered London Good Delivery bars and allows qualified holders to redeem shares for actual metal, held up comparatively better in terms of its structural integrity. The rotation toward allocated, physically redeemable vehicles during periods of price volatility is a signal that a subset of sophisticated investors is actively distinguishing between a paper claim on silver and an actual silver bar. That distinction did not exist in mainstream investment conversation 5 years ago. It exists now. The fourth signal is the COMEX coverage ratio. As of mid-April 2026, COMEX registered silver, the metal formerly available for futures contract delivery, stood at approximately 76.8 million ounces. Open interest on the exchange stood at approximately 575.5 million ounces. That gives a coverage ratio of roughly 13.4% and a paper-to-deliverable leverage ratio of approximately 7.5 to 1. The exchange operator, CME Group, has historically described ratios in the 5 to 8 range as normal, on the basis that the overwhelming majority of contracts, typically 97 to 99% historically, are rolled forward or cash settled rather than physically delivered. But the January 2026 episode demonstrated what happens when that assumption is challenged. In the week preceding the January 29th all-time high, delivery demands spiked toward 5 to 10% of open contracts, and 33.45 million ounces were withdrawn from registered COMEX inventory in 7 days. That represents 26% of the entire deliverable pool vanishing in a single week. The coverage ratio has improved somewhat since then, but remains in what analysts at National Gold Group and independent trackers describe as the stress zone, below 15%. The COMEX stress index, which incorporates coverage ratio, inventory trend, paper leverage, and vault outflows into a composite score, remains elevated. The fifth signal is the acceleration of the drain in the context of ETF structural limits. This may be the most technically nuanced point, but it is also the most forward-looking. Throughout late 2025 and into early 2026, a significant source of physical metal flowing into the LBMA free float came from ETF redemptions, specifically from SLV shedding vault stock as investors exited the fund. Each share redeemed resulted in an authorized participant depositing silver bars back into the broader market system. That buffered the free float. But as independent analysts tracking this market have noted, SLV appears to have reached a floor in terms of the vault stock it can drain to satisfy redemptions. If the fund begins accumulating again, as tends to happen when silver prices stabilize and investor interest returns, then the source of metal that has been buffering the LBMA free float disappears and the structural pressure on the free float intensifies. This is a deceptively important dynamic, a scenario where silver ETF inflows, normally a bullish signal for the metal, simultaneously tighten the physical market by pulling good delivery bars back into allocated, non-freely floatable custody. Now let me be honest about the bear case, because you deserve a complete picture and not a one-sided reading of selective data. The gross LBMA holdings at 27,454 tons in April 2026 are not at crisis lows. The COVID-era peak was 35,667 tons, but before that peak, the vaults were operating normally at levels well below it for years. The LBMA did not collapse in 2018 when holdings were lower. COMEX has survived elevated delivery demand before and has mechanisms including margin increases, position limits, and cash settlement alternatives that have historically contained disorderly delivery situations. Silver lease rates, while elevated versus the near-zero baseline, are not at unprecedented historical extremes in every tenor. The paper-to-physical ratio at COMEX of 7.5 to 1, while tight, is within the range the exchange defines as its operational norm. And perhaps most importantly, the silver price itself has corrected sharply from its January 2026 all-time high, falling from $121.67 to lows around $60 before recovering to the current range in the upper 70s to low 80s. A market truly on the verge of a physical settlement failure would not typically see a 50% price correction in 2 months. That correction matters. It shook out leveraged speculators, it temporarily reduced delivery demand, and it gave the market time to rebalance. The honest synthesis is this. The physical silver market is structurally tighter than at any point in modern history in terms of the free float to trading volume ratio. The 6-year supply deficit is not disputed, and the Silver Institute and World Silver Survey confirm it, and the cumulative draw on inventories is documented. The lease rate signal, the EFP spread, and the COMEX coverage ratio all point in the same direction, but the system has not broken, it has bent. There is a difference between a market under structural stress and a market in acute failure, and it is important to maintain that distinction rather than overstate the immediacy of risk. What I am watching over the next 60 days, and I want to give you a specific watch list rather than generalities, is the following. First, the LBMA May 2026 vault data, which will be published in early June. If April's net Western free float drain of 285 tons accelerates rather than reverses in May, the thesis that ETF redemptions were buffering the system will be confirmed, and the next phase of physical tightness will be measurable in real time. Second, the COMEX June delivery cycle. Open interest ahead of June 1st notice day will tell us whether the January delivery spike was a one-time event or the beginning of a structural shift in how institutional holders approach paper silver positions. Third, the 1-month silver lease rate. If it climbs back above 5% while spot price remains in the current range, that is a signal that price moderation has not resolved the underlying supply constraint. Fourth, the PSLV premium or discount to NAV. This is one of the most sensitive real-time gauges of retail and institutional demand for physically allocated metal versus paper exposure. A PSLV premium widening during a period of spot price stability would be a significant tell. Fifth, the UK trade data for silver imports and exports, which tends to lead the LBMA vault figures by several weeks. Net outflows from the UK, visible in trade statistics, typically precede corresponding reductions in vault holdings by a month or two, making it an early indicator of what the next LBMA report will show. Looking at the flow of metal through publicly available data and the structured analysis of primary sources, the picture that emerges is one of a market in which the paper architecture for price discovery is increasingly diverging from the physical reality of where bars are, who owns them, and how available they are for immediate settlement. That divergence does not resolve itself gradually. Historically, in commodity markets where paper and physical pricing decouple under sustained physical scarcity, the resolution is abrupt when it comes, not a smooth convergence but a repricing event. Whether or not that event materializes in silver in the coming months depends on variables that include geopolitical developments, industrial demand trends, the pace of ETF accumulation, and the behavior of large institutional holders with existing short positions. The silver lease rate, the COMEX coverage ratio, the Western free float trend, and the ETF structural dynamics all deserve your attention as analytical tools, not as sensational headlines. The data is available, it is public, and it tells a coherent story that the paper price alone does not. That is why this channel exists, to work through the numbers methodically and give you the analysis that would otherwise require a Bloomberg terminal and a morning spent in spreadsheets. I would encourage you to cross-reference the LBMA vault data, the COMEX warehouse reports, and the monthly lease rate readings yourself. The LBMA publishes its vault data on the 5th business day of each month. The COMEX publishes daily warehouse reports. These are your primary sources, and they are free. If you are tracking these metrics in your own research, I want to hear what you are seeing. Drop your observations in the comments, not speculation, but data. What premiums are your local dealers quoting on 1,000-ounce wholesale bars? What are the delivery wait times in your region? What is the PSLV premium showing when you check it? The community data that comes through this channel is often a leading indicator before it shows up in the formal reports, and that collective intelligence is genuinely useful. The next 60 days will be instructive for everyone watching this space.